Welcome back everyone, Michael here with another exciting video for you with Offshore Citizen. Today we're going to discuss I guess kind of misunderstood but fairly important subject, which is the difference between financial income and taxable income. So very, very important. I'm going to give you guys some little hints on some nuances around trusts that can be kind of interesting in this regard. But before we do that, click the subscribe button, click the notification bell, and let's get started. By the way, if you like the video afterwards, click the like button too. Okay, so the subject today comes from some work I was doing with respect to some clients and some providers, and somebody presented a tax structure to me which was, I would say, deceptive and wrong, unfortunately. So they were presenting the idea that you could defer this income, this tax, essentially perpetually on, virtually all your income in the US. And although there are some interesting structures for deferral that are domestic US structures, this one, they seemed to be misreading a little bit of how the tax code works. But it brought up an important distinction, which is the distinction between taxable income and financial income, okay? So why do I bring this up? Well, there's a variety of reasons here. First of all, because a lot of times people just pay attention to the headline tax rate. Like probably the most alluring, kind of the shiny penny, the distracting item for you is like when you're doing planning or thinking about it or something, is just to pay attention to tax rates, okay? And this is very distracting. To give you some idea, I was doing a little bit of a comparison yesterday between Singapore and Bulgaria, right? So Singapore has a corporate headline tax rate of 17%, and their personal income tax rate maxes out at 22%. And the reality is, so I was comparing it to Bulgaria. Bulgaria has a 10% tax rate. And the truth is, you can earn a fair amount of money in Singapore and pay less tax than in Bulgaria. And this is especially true if you're in a situation where you have dual income earners. Then it's really, really the case. So that's an example of where the headline tax rate, they haven't accounted for the progressive nature of it. But it goes further than that. Because in Bulgaria, the tax write-offs are not the most amazing, and it's more cumbersome to do the write-offs. Okay, you tend to need to be set up a little bit better in terms of how you can manage and look at things. So anyway, that's what we're going to talk about today. Okay, so financial income is what people would be normally used to hearing about. All right, this is how much money do you make. Now, even this, you can get into something that we'll talk about in a future video, which is the subject of cash or accrual-based taxation or just accounting in general. That's its whole own thing for us to discuss. But in the meantime, what we want to talk about is we just want to talk about this difference between the financial. So when we're talking about the financial, basically what happens? You have income, right? And then you have expenses. And income less expenses, loosely speaking, we can start getting into, how do you account for depreciation? What do you do about interest? What do you, all these sorts of things. But loosely speaking, income less expenses equals profit, or revenue less expenses equals profit, net income, right? Again, we can get into EBITDA, we can get into amortization, depreciation, et cetera, et cetera, et cetera. We can talk about, okay, how do you account for, let's say that you do share-based compensation, so how does that get accounted for? And so in these cases, you can have a net loss, but you can have positive cash flow. And so there are some distinctions here that are worth understanding when you're, first of all, for sure when you're investing, right? A good example of this is a friend of mine a while back was interested in investing in Twitter, and he asked me to take a look at it for him. And Twitter was running a fairly substantial loss, but they had positive cash flow. And when you dig into it, you discover, well, the reason for that is because they have all this share-based compensation that was being accounted for that was not cash-based compensation. And so, they ended up with positive cash flow, which is a good thing, but a net loss. So anyway, lots of these types of things. If you read the book, The Intelligent Investor, a great book, they go through and they talk about kind of how easily earnings can be manipulated. Okay, and there's certainly lots of possibilities for that. Let's contrast that though, like even if let's just simplify it down and say that, okay, even how you account for that, for the most part, for most small businesses, when they think of profit, they're thinking about, I had a certain amount of revenue, right, which is the amount of sales that come in the door. Then I had expenses. These are cost of sales, cost of goods sold, operating expenses, etc. And at the end of that, I have some bottom line, which is my net profit, right? My net profit. That's what people are thinking of, okay? And they tend to think of cash and profit as the same thing, even though cash flow can kill your business even when you're profitable, or vice versa, as I mentioned, okay? Now let's go on to the other side. On the other side, we have taxable income. What's taxable income all about and why is it different? Well, the bottom line is you still have your revenue, okay? But it is possible that your revenue does not get treated in quite the same way, right? There might be tax-exempt income, okay? So that might not count towards your taxable income. Then your deductions, your expenses, are not necessarily the same between the financial side and the tax side. And I'm going to use a very simple example that I use quite often, which is the subject of meals, okay? So I'm from Canada originally. If you're in Canada and you're running a business and you go out for lunch, you say you take out a business partner or a client or an employee or something like that, and you pay for it as a company expense, right? You can only write off 50% of it, okay? So let's say it was a $100 dinner, okay? So let's say that you had whatever your income was for that day, say it was $1,000. Well, you can't deduct $100 from that $1,000. You can only deduct $50 from that $1,000. And this is a very important difference because, say, in Hong Kong, you could write the whole thing off, right? In Bulgaria, you might not be able to write the thing off at all, or it would be more cumbersome. People will say, oh, well, I'll just pay the 10% tax on it. Okay, you could do that. But if you end up doing that, then you're not comparing apples to apples when you're looking at some place where you can write off expenses versus where you're not writing off expenses. So this is it's a very important difference in concept. And so just be aware that this can work for you or it can work against you. So give you a quick example here of how it works for you versus against you. All right. So a lot of people, let's say they're in the real estate business. Okay. In the real estate business, they would say, okay, I bought a property, right? And I have a certain amount of income coming in from my renters, and I have certain expenses. Maybe I'm doing some maintenance, maybe I'm paying some property management fees, maybe I have some insurance, etc., right? And at the end of the month, I have positive cash flow, maybe, right? But on the tax side, I might actually be losing money. It's what we call negative geared properties. So this is where it might be positive cash flow, but you have a loss from a tax standpoint. So this is when we look at what happened with, to some extent anyway, what happened with Trump's tax returns, where we saw this, very small amount of tax paid in spite of an enormously large income as well. In addition to all the other write-offs, he was able to claim depreciation on the property. Okay, so depreciation is something that might work for you in terms of how you would deal with your tax accounting, but maybe not how you would normally think about it from a financial accounting standpoint. So anyway, the bottom line of all of that is, you need to be able to understand these and you need to play around with them. This is where we talk a little bit about effective tax rates versus real tax rates, and you'll get some arguments on this, right? People will say, okay, well, the effective tax rate in the US, even though, say, the corporate tax is 21%, the effective tax is 13% or something. This is kind of where people are playing with those numbers. The truth is the tax rate is still 21%, right? But the way that the tax rules are structured allow you to take advantage of a bunch of things that could be really beneficial for you. And so anyway, that's the summary of financial income versus taxable income. There's this area I was going to mention to you, which is with respect to trusts. So trusts are often taxable. They could be taxable to the settlor/grantor, to the trust itself, or to the beneficiaries. And often you'll have rules whereby distributions that are made reduce the taxable income of the trust, or the amount of tax that the portion of the income that the trust has to pay tax on. There's I don't want to confuse too many terms because we get into lots of different trust-related terms that, depending on where you are in the world, we could get slightly inaccurate. But anyway, the bottom line is just that you may end up in a situation where, depending on what's happening with money, you could end up not getting taxed as much, or you could get taxed more if you do it poorly. Maybe one last thing that's worth noting is that if you borrow money, borrowed money is not taxable. So that's another example of where you can move money, you can have cash in your bank, you can utilize that money potentially without paying tax on it, at least for the current point in time. And so this is another thing they do with trust, is sometimes you'll put an appreciating asset into a trust, and then you'll have some sort of a loan that's being issued. So basically, the trust is making payments on that, the purchase of that asset. And so based on that, you're ending up with kind of a reallocation that's taking place that's quite helpful. So anyway, hope that was helpful. If you liked the video, please click the subscribe button, click the notification bell. Would really appreciate your support. Click the like button. And if you would like to reach out to us for assistance with tax, asset protection, company formations, bank accounts, residencies, citizenships, etc., you can click the link below. You can book a call with me, clarity.fm/Michael Rosmer. You can also go to our websites, offshorecitizen.net, offshorecapitalist.com, and I'm going to see you guys on the next video.